Hello, my name is Pete Hoover, and today is Monday, October the 19th, 2020. I'm here today with Steve Gibson, our Chief Investment Officer, and we wanted to provide our clients with a market update. Steve, it's the fourth quarter. Many of our clients are wondering what's happening with our economy and where are the markets going between now and year end.
Well, Pete, so far, thanks to the Federal Reserve, we've made up about 70% of the damage that we had in the decline in March. And it really is the Fed that's driving, particularly the stock market, higher. But at this point, we're starting to stall. And the reason is that the market's expected two big stimulus efforts. We got the first one, which was very bullish. And now we're having difficulty getting the second one done. Our view is probably we get the second one. I'm not sure we'll get it before the election. But the markets will get stronger and maybe climb higher if we get that stimulus. If we don't, it could get a little choppy and a little sideways. But I don't see a super decline at this point.
Steve, we got a couple weeks until the election. What do you think, what role is the election going to play on the markets going forward?
Well, one thing we've said in several of our pieces is that there are a lot stronger drivers of investment results than the elections. Elections probably wouldn't make the top 3 or 4. That doesn't mean we can't have temporary kinds of impact from the elections. But one thing we're seeing is that as Biden's lead in the polls, at least, has gotten stronger, there's not that strong feeling that if he gets elected, the markets will tank. It doesn't mean we won't see some effect, but it's going to be very temporary, and really I think we would quickly shake off any impact of that. And of course, there is some concern that if the election is close, that we're going to see some uncertainty, and the markets don't like that. We could see some reaction to that. But again, it's going to be temporary. So at this point, I think you can look through or past anything with the elections.
So I know that we have been taking a lot of action steps on behalf of our clients. Can you give us some sort of recap of what those steps look like?
Well, one of the things we wanted to do was to get larger and more growthy, and we added the triple Qs to do that, and we trimmed back a lot of value position. Now, it looked for a while like there was going to be a rotation toward value, and that's what all the financial shows were talking about. That lasted until the beginning of October when earnings started coming in, and we saw just okay financials on the value side, but excellent reports from the technology companies. So once again, we're seeing growth really assert itself at that point. The other major move we've made is that we've added the JP Morgan hedged equity. And that's because we don't yet have stimulus, and we do have some uncertainty over the elections, and we've come back awfully fast. But the big concern there is the rising surge of the COVID-19. Just in case this really starts to look as bad as it was in 2018, where they got their big wave now, we wanted to be a little more hedged in the equity side, so we have that more defensive equity portfolio.
You know, a lot of our clients have fixed income positions. Any thoughts on where the bond market's going?
Well, the Federal Reserve had a tremendous impact. This may be one of the best fixed income bond years we will see for some time. It's certainly better than the ones we've seen over the last few years, because the Federal Reserve basically has said we're going to keep buying bonds to keep interest rates low, and they've done what they said they're going to do. And by the way, they plan another $1.7 trillion if it's needed, and have told us they're going to buy all the way through next year. That's unbelievable. We used to try and guess what the Fed was up to. Now they tell us a year or more in advance what their policies are. So bonds are somewhat predictable, which is good. We don't see any inflation, so we don't see rising rates, which is the only bad thing we would want to see in the fixed income world. So we're pretty happy. It's stable. We've made good money there this year. We particularly like municipals because if Biden gets elected, and it looks like he's leading, that's going to be pretty bullish for municipal bonds because they are tax-free.
Steve, is there anything else that you're either worried about or focusing in on for the balance of this year?
Well, I do hear a lot of investors saying, well, probably the markets are going higher, but I'm just going to go to cash for right now. And that's always very tempting, and the decision to go to cash can be fairly casual. Why not go to cash? But I would really caution investors that when you go to cash, you make two decisions. You make a decision to go to cash. That can be somewhat difficult. The big decision that's very difficult is when do you get back in? And I've named a couple of positive things that we're going to see. If we get a stimulus, if we get a vaccine, if we get good therapeutics, if the election uncertainty passes, if we get a good GDP number, any of these things could cause the markets to really move higher. And if you start missing some of those rallies, over time it really affects your portfolio. So I would not be trying to time these markets, because if we look past these little temporary things, even COVID will go away, then the markets look pretty bullish to me beyond that.
Steve, thanks for your time today. If ever you have any questions or concerns, please contact me, Steve, or your financial advisor, and we'll be happy to help you through this difficult time and help you to achieve your goals and objectives. Thanks for listening.
Thank you.